Hi, this is Naim from Zeevou, and today I'm going to talk a bit about how to assess the performance of your properties and how to optimize your business profits by learning when it's time to grow and when it's time to let go. So, no doubt, those of you who've got more than one unit will have noticed that some of them do better and some of them do worse. Obviously, no two units are ever going to perform exactly the same. However, it's important that you've got clear KPIs that you're tracking and you've got an easy way of doing so, and you can notice any red flags as soon as they start to appear. With listings, it can take some time until they get to a point where they're realizing their full potential. So as a word of warning, I would say never try to make a call too early, and make sure that you've got enough cash reserves before you set up a new unit to be able to see you through 3 months, 6 months, maybe even 9 months of suboptimal performance before things pick up. And make sure to also factor in any seasonality. So if you're setting up a unit at the tail end of the summer, you might have almost a full year of real struggle if your market isn't doing great before you start to make money, and then hopefully pick up on the second year once you build up some clientele to fill that unit. If you've got enough units going, we've already built a strong brand, I've discussed this in some of my previous videos, and you've got direct bookers coming in, then obviously you can reduce that risk by trying to even only set up units once you've got enough demand, which is the ideal way of doing it. But obviously that's not always possible. Opportunities come up left, right, and center. But the main things I say is once you've set something up, you need to track across your portfolio how your different units are doing, and then know when it's time to let go, when it's time to invest in some properties more than others to try and boost those earnings that they're already doing well. And today I'm going to talk you through details around this, how to find out easily which properties are performing the best and which ones aren't. One of the best ways of figuring out whether a unit's going to work in the long term or not, regardless of what the financials are doing right now, is to look at the guest feedback. There are some indicators of poor performance or of a unit not working in long term, and I'd say reviews are number one. You want to very closely monitor reviews that you're getting off the back of the new booking, and that can be slightly difficult to track if you're getting bookings across multiple platforms. You could use something like Zeevou to centralize importing bookings and then being able to also look through them at a unit basis and see what the commonalities are between issues that gets maybe flagged. Obviously, if a booking is doing really well in terms of reviews, even if the financials aren't quite there yet, that gives you hope that in the future those reviews will attract more bookings and your occupancy and profits will increase. Now, in this case, what we want to watch out for is low reviews or reviews that are good but have complaints built into them, and you need to make sure you resolve those complaints so that your overall rating doesn't drop over time. The other obvious factor is looking at margins. Now, margins can be slightly difficult to get a grip on and to predict how things are going to go in the future, as I was mentioning earlier, but you can still look at trends. Now, the trends you want to be looking for are probably month-on-month performance, day-of-the-week performance, and you want to see how that is changing over time. You need to, of course, factor in seasonality as well. So sometimes it's not possible to really make a call in the first year of running a hospitality business or setting up new units in a new market, and you just need to give it time to see how it pans out, and in the meantime, be laser focused on ensuring the reviews are great. Now, when you're looking at your margins, you obviously can look at, or if you're looking at your KPIs, I should say, you can look at different figures. You can look at sort of the total revenue that you're getting from selling to guests, and you might be looking at your accommodation sales. Don't forget to also take into account any upsells, and if you're not doing upsells, you should seriously start looking at which upsells would work best and get the most revenue. And I'll be doing a separate video on upsells in the near future, so make sure to subscribe to our channel on YouTube and follow us on social media if you're interested in finding out more about that. And I mentioned in one of my previous videos about how you can also use Zeevou to automate a lot of the upselling that you do to guests. So let's just focus on the accommodation revenue for now. If you're looking, at the total revenue, accommodation plus any upsells that you've got currently going, you want to look at the total income that you've got, and you want to make sure that that is basically increasing month on month, or if there's seasonality involved year on year, you're seeing an improvement compared to the same time in the previous year in your total sales. And then you need to make sure that you're keeping close track on your expenses, whether they're utility bills or turnover costs. And with inflation going crazy in a lot of parts of the world, you need to really do that on a very regular basis so that you can keep track of a squeezing profit margin, because nightly rates don't necessarily go up, but if your costs keep going up, then a once profitable unit might turn into a loss-making unit, and you need to make sure that you can get on top of that as quickly as possible to then decide what do you do with it. There's obviously different ways out of it. It doesn't mean that you need to let the unit go, or you get to sell it or hand it back to the owner necessarily. You could look at adding upsells, you could look at freshening touching up the listing, taking new professional photos, improving the description, doing more direct bookings, listing on other channels and OTAs and so on and so forth. Another way of helping to improve the financials on loss-making units is to look at your revenue management strategies, which I discussed in one of my previous videos, where I talked about how even if your calendar is full, you could still be losing money, and what strategies you need to implement to ensure that you actually focus on maximizing profitability. Now, as I was mentioning, you need to tally up your income and all your expenses, and you need to look at the profit that you're making at the end of each month. And you want to see how that profit is doing month on month, year on year, to take into account seasonality as well. And based on that, you're hoping that every unit would be profitable. Now, in a lot of markets, you won't make profit 12 months of the year. So at that point, you need to start looking at your annual profit margin. But if you're tracking year on year with previous years, you at least don't want to be seeing a drop in your profit margin. If you do, then that's a red flag and it means that there's something you need to do to address that to ensure the long-term viability of your business. Now, you could be asking yourself, well, how do I track this? It's actually easier said than done. We've built a lot of tools into Zeevou so that you can have software that can really help you automate the tracking of it. So we've got what we call monthly profit reports, where Zeevou will look at all the income you're making from accommodation or from any other upsells that you've got, and it'll produce what we call a monthly profit report or an owner statement. So what this does is, whether you're renting the unit, you own the unit, or managing for someone else, and you can tell the system exactly what your setup is and what the financial split is between yourself and the owner. And then you will get a report generated on a monthly basis in real time that shows you the income for that month. And we do pro rata by nights and months. So if you've got a long booking or booking that crosses across more than 1 month, we'll chop it up, split it down, then only allocate the income from the nights in each month to that month. And then we'll deduct any expenses from that. You can tell the system how you want expenses to be split between yourself and the owner if you're managing for someone else, or if you're renting for someone and have an agreement where you're paying bills on their behalf or something like that. And then you'll get a clear figure for your profit, how much profit you're making from that deal with a landlord, which could be for a single unit, could be for a whole apartment block, a hotel or a guest house or whatever it may be. And that bottom figure of profit that you're making is the one that you need to really obsess about. There's other levels at which you can start analyzing things. For example, you could look at your net profitability after overheads. So obviously you've got costs associated with the unit, and then you've got overhead costs associated with your head office staff. So you might have VAs, you might have revenue managers, a finance team, marketing, sales, whatever. Obviously you want to try and allocate your sales and marketing to being regarded as cost of goods sold. And then some, you can sort of play around with those more, right? If you ramp up your sales and marketing spend, the hope is your revenue will go up. But then there's some sort of back office overheads you can't really do much about, like say your 24/7 guest communications or your finance team. Those are relatively fixed. And you need to make sure that you're also tracking your profitability after those overheads, because you don't want to be losing money as a business overall if you've got profitable units. And you might need to look at reducing your staffing costs at a head office level if your unit's profitable, but you're still losing money overall, by automating more, by employing software, by looking at any inefficiencies you might have in the system. And then, of course, if you've got debt in the business, you might also need to look at how you structure your debt to ensure that in the long term, you're profitable and cash flow positive. So these are just some thoughts that I thought you might find useful when you're looking at trying to analyze the profitability of your units. And as I say, it's not always black and white that you just have to cut your loss-making units. You might undertake initiatives to improve the profitability of those. And of course, you also don't want to forget about your best performing units, or units where you see there's potential that the reviews are sort of somehow letting it down. And you really want to look at each unit each month and do a month-on-month and year-on-year comparison to know when to double down and when to pull back. And remember, handing units back or selling a unit isn't necessarily the end of the world. By getting rid of the loss-making unit, you're actually improving your profitability vastly, because it's not like you're just losing a potential source of income, you're actually losing current source of loss, if you will. So in certain situations, you might just need to have the guts and say, look, I've tried my best and that's all I can do with this unit. It just doesn't work. The market isn't there, the creation isn't there. It would require too much investment to turn profitable and make the cut. But in a lot of situations, it might be that your marketing needs to be improved, your revenue streams might need to be increased by upselling, for example, or you might need to look at listing it on more websites or string-of-inning your own direct bookings for those listings. If you have any questions regarding this, feel free to drop a comment and we'll get back to you. And don't forget to subscribe to our channel on YouTube and to follow us on our social media at Zeevou.